Hello everyone, today we will be conducting a very quick review of the portfolio. We'll be looking at how it has performed against the benchmarks, what the allocation is looking like, and a very quick review of my investment thesis for each of my holdings. As we can see right here, we have been doing pretty well in comparison to investing in the S&P 500. Up here we can see what would have happened if we were not investing, what the scenario would look like if we hadn't been investing in the S&P 500, and how our portfolio is holding up. Of course, this past year has been very green for the major indices and for most companies, but we can see how we have performed against the S&P 500, the Nasdaq, and the New York Stock Exchange. This graph over here shows our performance versus the S&P 500, where the big chart is our performance and the small lighter one is the S&P 500 performance. This looks a lot better if we just look at the excess returns, meaning the difference between our performance and the S&P's performance, where every single month it has been different, but overall when accumulated we have gotten ahead, mostly because of our outperformance during the first quarter of 2024. But now we're going to jump into the fun part, which is our portfolio allocation. We currently have 8 stocks in our portfolio. We're building up whenever we find very high quality companies that are going on dips. We decide to buy those. But overall, I would like this portfolio to keep being very concentrated because I like to keep track of my stocks, read the quarterly reports, and just know exactly what I'm owning. Right now, our biggest position is in Crocs, but this is because it is one of the companies that has run the furthest. Let's go one by one and analyze the investment thesis. So let's start with Crocs, which is my biggest position. I entered this position at the end of 2023 when I saw this stock actually trading under $100, and I decided to buy a couple of times just before it actually decided to shoot up and reach its 1-year highs of almost $160. Then recently it started to actually pull back, and I decided to buy at another dip that I saw closer to $120, which has pushed my average cost of Crocs to around $101. Now my main thesis for this company is that I decided to start investing in it when it had just conducted an acquisition of HeyDude and it was having a tough time. Why? Well, because it was over leveraged. It had a lot of debt on its balance sheet and it was having trouble clearing out and actually managing its interest payments. What I saw here was a very strong free cash flow generating machine which had its priorities straight, as management repeated along all of their earnings quarters that their main priority was going to be to actually repay their debt, and that once they had repaid their debt and reached an acceptable ratio, they would start with massive share buybacks. And I'm happy to say that in the previous quarters, they were already conducting some share buybacks when the stock was dipping. So currently I have no plans to sell this company and I'm extremely happy owning this for the long term. Next we have S&P Global, which I bought again at the start of this portfolio and I've been adding to it since it didn't take off quite as quickly as Crocs. However, this company I believe is extremely solid. This is what I would call a long-term compounder. One very nice thing I like about this company is that it is going to benefit from the interest rate decreases, because a lot of companies are going to start refinancing, and in order to refinance they will need their debt rated. This is where one of the strongest sectors from S&P Global actually comes in, and this is why in the latest quarters their revenues have actually started to tick up aggressively. Again, I love this company because it is one of those where you can buy it and just forget about it and you know that it will outperform the market in the long term. Following this, we have a fairly recent buy, which was Salesforce. I decided to scoop some of these shares after the earnings reports where it actually tanked over 20%. And over the past few months, I have actually been building a stronger position in this company, where now in October, we can actually start to see it tick back up to where it was in around March, April of 2024. Investors got scared of this company because its revenue was actually decreasing. But what I saw in the earnings report was that, of course, the revenue was decreasing by a little bit. However, they were managing to expand both their profit margins and their free cash flow margins. And in the end of the day, it's not about how much you make, it's about how much you can keep. And if Salesforce is increasing the amount of cash that they can keep, that's something that I want to be part of. Additionally, Salesforce has stated in multiple occasions that they are going to start to be a lot more responsible with their cash flows. They're going to start buying back shares more aggressively, and they even started paying out a dividend, which I believe will grow out very nicely. Next up, we have Lantheus, which is our best performer so far. This, of course, we bought a long time ago in April 2024, and since it had run up a lot, we decided to not buy anymore. However, in August 2024, after it had some very good news and shot up around 30% in one day, it started to dip down a little bit, and I decided to increase my position since my conviction in this stock had improved. I understood a lot more their business, and I saw that they were doing the right things. I believe that this company will be a long-term winner, and I have no plans of selling it. In fact, I'd be happy to actually see this company dip down in order to build a bigger position. Next, we have Booking Holdings, which is one of my highest conviction stocks. Of course, this was a very good buy in a dip that happened in August 2024, and since then it has had a very good run. This company is massive in Europe. It's already starting to have monopolistic problems with all the different jurisdictions. However, it hasn't tapped into the US market just yet. And I believe this stock has massive growth potential. I believe that this company is one of the best in the market at generating free cash flows, and they're investing them extremely responsible. If you look at a chart at the share buybacks that Booking has conducted in the past years, I believe they're one of the most aggressive stocks to do this out of the whole market. And of course, that has to be part of the reason of why their stock has outperformed the S&P for so long. So I do actually want to be part of this business, and I'm happy with my position. If I get the chance, I will increase it, and I don't have plans to sell this anytime soon. Next, we have our big loser, which is Perion Network. I did a couple of videos on this before actually buying the stocks, where I was talking about the fact that this was a very high risk, high reward play, and at the moment I'm not looking at the reward. This only goes down, and I don't expect it to actually move in the near term. I think the management actually lost the confidence from a lot of investors, which is why it is actually trading down, and I think that it will need a lot of very good quarters before actually recovering. This is the only position that I actually have doubts in my portfolio, and I think I'm just not selling because I'm scared to sell at a loss, but I will have to actually review this company and try to get my head over it, whether this money could be invested somewhere else and get a better return. Next, we have MasterCard, which is a position I never actually got time to build out properly. I bought in November 2023. I decided to buy again in August 2024, which was not the best timing, but I still did not have as much conviction on it. And the fact is that both of my buys, we can see over here in the excess total return, have performed very in line with the S&P 500. And finally, we have our most recent buy, which is Google Alphabet stock. I remember doing a couple of Patreon posts about this, and I do believe that I actually made a YouTube video about this just before actually purchasing the stock, but I think I got a very good price for Google. I bought just right at the dip, and of course it has been performing extremely well since those lows. I do believe that this company is still undervalued because they're being hammered down by the media. I think this is one of the most dominant companies in the world. Their cloud segment is growing strong. They're one of the most underrated AI players, which maybe they're not looking as good right now, but this company is investing massive amounts of cash into both these segments, which are very high growth. Of course, we do have to consider their monopolistic lawsuits, but these never lead anywhere. Microsoft and Apple have faced so many of these, and right now they're bigger than ever. So again, I don't have any plans of selling Google soon. If possible, I would actually like to increase my position because I love this company. Finally, although I'm not a dividend investor, it is nice to see some of my companies actually paying dividends. I only have a yield of 0.14%, but my biggest payer is S&P Global, which has around a 1.5% dividend yield, I believe. And then Salesforce and Booking are companies that just stated dividends and starting paying them this year. But it is very nice to actually see the payment dates and the annual increases of what these could get up to. So anyways, it has been a very long time since my previous portfolio review, so let me know if you enjoy these videos. I certainly enjoy making them. So thank you for watching. As always, this has been the Cashflow Compounder. See you in the next one.